Most people destroy their wealth the moment they hit $25,000. Not because they're reckless, because they invest in the wrong order. They dump everything into crypto, hoping to get rich quick. Or they leave it sitting in a savings account doing nothing. Both mistakes cost you years of compound growth. Today, I'm breaking down the exact step-by-step order to invest your money after you hit $25,000. This is not theory. This is the proven system wealthy people actually follow. And if you get this order wrong, you could be leaving tens of thousands of dollars on the table over time. Let me show you how to do it right. Before we dive into the steps, let me explain why order matters. Investing is not just about what you invest in, it's about when and in what sequence. Think of it like building a house. You don't start with the roof, you start with the foundation. Same with money. Each step builds on the last. Skip a step, and the whole thing falls apart. The order I'm about to give you maximizes returns while minimizing risk. It takes advantage of tax benefits, it protects you from emergencies, and it sets you up for compound growth that actually lasts. Most people skip straight to step 5 or 6 and wonder why they're not getting ahead. Do not be that person. Step 1. Max out your 401k match. If your employer offers a 401k match and you're not taking it, you're literally leaving free money on the table. Here's how it works. Let's say your company matches 50 cents for every dollar you contribute, up to 6% of your salary. If you make $60,000 a year, that's $3,600 a year in free money. You contribute $3,600, they give you $1,800. That's an instant 50% return. You can't beat that anywhere. Not in stocks, not in real estate, nowhere. And here is the thing. That match is not taxed until you withdraw it in retirement, so it grows tax-deferred for decades. For almost everyone, step 1 is max the match. This is the easiest free money you will ever get. Step 2. Build your 6-month emergency fund. You already have $25,000 saved. That is great. But is it enough to cover 6 months of expenses? For most people, 6 months is closer to $18,000 to $25,000, depending on where you live. If you're not there yet, top it off. Put this money in a high-yield savings account earning 4 to 5% in 2026. This is not an investment. This is insurance. If you lose your job, if your car breaks down, if you have a medical emergency, this fund keeps you from panicking and making bad decisions. Without this safety net, you will be forced to sell investments at the worst possible time, or go into debt, or both. Once you have 6 months of expenses fully liquid and accessible, you can move to the next step, not before. Step 3. Pay off high-interest debt. If you have credit card debt, personal loans, or anything in the double digits, pay it off now. Here's why. Let us say you have $5,000 in credit card debt at 20% interest. That's costing you $1,000 a year just in interest. Even if you invest in the stock market and get 10% returns, you're still losing money because the debt is eating you alive at 20%. Paying off high-interest debt is a guaranteed return. You cannot lose. Kill the debt, then move forward. Now, here's the exception. If your debt is low interest, like a 3% car loan or a 4% mortgage, do not rush to pay it off. You can earn more investing that money. We'll get to that in a minute. But if your debt is significantly higher than what you can reasonably expect to earn investing, prioritize paying it off, especially double-digit rates. Step 3. Step 4. Max out your Roth IRA. In 2026, you can contribute up to $7,000 a year to a Roth IRA. And this is one of the best wealth-building tools available. Here is why. You pay taxes on the money now, but then it grows tax-free forever. And when you retire, you can withdraw it all tax-free. No taxes on gains. Ever. Compare that to a traditional IRA or 401k, where you pay taxes when you withdraw. With a Roth, you lock in your tax rate today. And if you're young and in a lower tax bracket now, that is a huge win. Plus, Roth IRAs have no required minimum distributions. You can let it grow as long as you want. Max this out every single year, $7,000. Do not skip it. Step 5. Max out your 401k contributions. After you have maxed your employer match and your Roth IRA, now you go back to your 401k and max out the full contribution limit, around $23,000 per year as of 2026. This grows tax deferred. You get a tax deduction now, and you lower your taxable income today. Most people invest this money in low-cost index funds inside their 401k, funds like the S&P 500 or total stock market funds. Historically, these funds average 8 to 10% returns annually over the long term. This is where serious wealth building happens. At this point, your retirement engine is fully built. Everything else from here is about acceleration. Step 6. Health Savings Account, or HSA. If you have a high-deductible health plan, you're eligible for an HSA. And this is one of the most tax-advantaged accounts available. You get a tax deduction when you contribute, it grows tax-free, and you can withdraw it tax-free for medical expenses. That is a triple tax advantage. In 2026, you can contribute up to $4,150 if you are single, or $8,300 if you have a family. Now, some people prioritize an HSA earlier because of that triple tax advantage. That works too. The key is stacking tax-advantaged accounts before taxable investing. Most people use HSAs wrong. They spend the money every year on medical bills. Do not do that. Pay for medical expenses out of pocket and let your HSA grow. Invest it in index funds inside the account. In 30 years, you will have a massive tax-free pile of money you can use for healthcare and retirement. This is a secret weapon. Step 6. Up to this point, you have built protection and tax-advantaged growth. Everything from here on is about flexibility and optionality. Step 7. Taxable brokerage account. By now, you have maxed tax-advantaged accounts. You have your emergency fund. You have no high-interest debt. Now, you open a taxable brokerage account. This is where you invest money you might need before retirement. It's flexible. You can withdraw any time without penalties. The downside? You pay taxes on gains. But if you invest in index funds and hold long-term, you only pay capital gains tax, which is lower than income tax. This is for money beyond retirement. Maybe you're saving for a house in 10 years. Maybe you want financial independence before 65. A taxable brokerage account gives you that flexibility. Step 7. Step 8. Real estate or alternative investments. Notice this is Step 8, not Step 1. Most people want to jump straight into real estate, crypto, or individual stocks. Big mistake. You only do this after you have completed Steps 1 through 7. Why? Because those steps give you a rock-solid financial foundation. They protect you. They grow your wealth safely. Step 8 is where you take calculated risks. Maybe you invest in rental properties. Maybe you buy REITs, which are real estate investment trusts. Maybe you allocate a small percentage to crypto or individual stocks. But this is the final step, not the first. For most people, limiting alternatives to around 10 to 20% keeps risk manageable. Here's the biggest mistake I see. People skip steps. They hear about someone making money in crypto when they dump their entire $25,000 into it. No emergency fund, no retirement accounts, no diversification. Then the market crashes and they lose everything. Or they buy a rental property but they have no cash reserves, so one bad tenant wipes them out. Do not skip steps. Follow the order. Boring wins. Consistency wins. The wealthiest people consistently follow systems like this, step by step, year after year. I call this the 25K wealth ladder. The market does not reward excitement. It rewards discipline. So here is your action plan. Look at where you are right now. Have you maxed your 401k match? If not, start there. Have you billed 6 months of expenses? If not, do that next. Then move down the list, one step at a time. You do not have to do everything today, but you do need to follow the order. That is how you turn 25,000 into 100,000, then 500,000, then a million. Where are you in this order right now? Drop a comment and let me know. And if this helped you understand exactly what to do next, hit that subscribe button. We're building wealth together, one smart decision at a time.